Well, hello, everyone. This is Cynthia Tomaine with Interactive Brokers, and thank you for joining today's webinar with New Constructs, where we'll be discussing modern research tools for modern markets. Now, before we do get underway today, I do want to show you or demonstrate how you can access the information that we are going to be discussing in today's event. So let me actually pull up my website. Let me pull up the Interactive Brokers website, and let me go in here. Let's simply move over to here because I did want to show you where you can find out information on the New Constructs research platform that's provided and integrated into your version of Trader Workstation. Now, first of all, notice from our website, the first place I want to take you to is the pricing menu, which includes research news and our market data features. Notice as I do go into this platform here, you'll see that there are some jump links that are included at the very top of this page. Now, if I do go into the research news, you'll see that several different sections are available. And notice while we do have some subscriptions that are included, I did want to take you, and I'm going to simply scroll down a little bit further on the platform. And let me see, we should find New Constructs. Let me see here. Did I pass right over it? I may have passed right over. Or actually, let me look. I had it open and running before, and there it is. It does fall alphabetically under the section here. And notice, thanks, David, how there are two different research packages that are available. Notice that also included here is a link to the New Constructs website, where you can find some additional information and even view some of those sample reports. Notice here the samples are available. I'm not going to click through this link, but you certainly can. And then also you can access the New Constructs website, which I believe David is going to be taking us through later on in today's session. Now, this is basic information about the research package that's available. And how would you actually access or subscribe? Well, notice you can go into the new account management. I already do have that up and running. And you'll see here that, well, first of all, it's under the settings menu, and the user settings is where you'll be able to find, let me go back to the settings. Notice here, research subscriptions are available. Notice using that configure gear icon will bring you right into the page where you can see those subscriptions that you do have available. And notice New Constructs is there. But also, if you do want to subscribe, notice here that you can go directly into that configure gear icon and then simply locate New Constructs. And once again, it is listed alphabetically. So we'll jump down to New Constructs, and notice here is the information. Simply put a check mark in this box to be able to activate either one of these subscriptions. Now, by the way, also notice here that the information icon will provide you with some additional features or additional information on the package that's available. Now, I also do want to point out what I am going to do is go into my account management system one more time. Let's go to the Interactive Brokers website because some of you may still be located on our previous version of account management. What I'm going to do here is actually sign in. Let me go. Let me see, and I think I need this 962. Let's see if I can get in because we do have two different versions of account management. You'll find here, let me see, let me make sure that this is the correct login. Let me try again. Sorry about this. Oh, I think I may have left a space there. Because on the old version of account management and on that page that I just showed you, you'll be able to see the instructions to access. Now, it looks like I'm not going to be able to log in. It's still waiting. Here it comes. Now, where you'll be able to go is underneath the Manage Account section. Notice under Manage Account, there's Trade Configuration, where you can also find those research packages that are available. Now, here is where you would subscribe. And what I do want to point out is that notice that all of our subscriptions do include a free 30-day trial period. So let me jump down to New Constructs. Once again, you'll be able to find that information. I think I may have scrolled right past it here. And here we have it. And you'll see that, notice, if you haven't tried or would like to get a free trial period, notice that it is available and you can simply click through for that free trial. Now, once you do have the subscription, I also want to show you that it has been seamlessly integrated into the account, into the Trader Workstation. Also, it's available in our IB mobile app for tablets. So if you do have that app, you'll be able to access the research there as well. Now, notice underneath the New Window button, we're going to go down to find Analyst Research. Here is where you'll be able to access, and this one's a little bit easier for me, notice here, going into the New Constructs page. Now, notice how this opens up for the most recent articles that have been released, and you'll see there's quite a bit of information that's available. By the way, you can get to the New Constructs website directly from this window, but if you're looking for something in particular, notice that More button will actually open up a separate page, and now notice that underneath the company news is where you can type a particular ticker symbol. By the way, I'm just going to type a random symbol in here, and notice how that will bring you to the specific information for the ticker symbol that you've just opened up. So with that, wanted to show you very quickly how you can access that, whether you're looking at a free trial period or have subscribed to those markets, that market research. So with that, I'm going to minimize this. I'd be happy to answer any of your questions, but let's get back into our presentation today. And I'm going to turn this over now to David Traynor, who's going to deliver the modern research tools for modern markets. David is in the background and has patiently been waiting. So let me actually make David the presenter. And David, if you would simply share your desktop, let's get underway with the rest of today's presentation. Thanks for joining us, David.
Thank you, and thank you for providing that detail on how to access the new constructs on interactive brokers. Had a lot of clients, potential clients, have some trouble with that, so I'm glad to have some clarity around that. And I appreciate how you pointed out, Cynthia. You know, if you're having trouble accessing on interactive brokers, there are a lot of links directly to the New Constructs website, so feel free to sign up directly. Now to the heart of the matter. Look, we live in technologically driven times, and most of the last 15 to 20 years, we've seen little to no improvement in technology when it comes to investing. And so what I'm here to talk to you about is how technology will change the investing process. I'm not talking about trading. We all know we can trade faster and easier. We don't need to call a broker. We don't need to send a check to a mutual fund company. We can do these things instantaneously. But trading is not investing. Buying and selling of shares is trading in essence, right? But doing that intelligently is investing. And I want to talk to you today about how you can do that more intelligently, because the world is changing in terms of how much information is being put into your hand. New Constructs was founded over 15 years ago to democratize access to investors of all types. The same information that the big Wall Street insiders and other folks have access to and have used to, in many ways, exploit an information advantage over the retail markets and the self-directed investing marketplaces for many, many years. And I know because I used to work on Wall Street. I was on Wall Street starting in the mid-90s and through the tech bubble, and I can tell you firsthand that the quality of research that makes it out to the retail is very different than what goes on in the conversations with investors in the back rooms and in the meeting rooms with the institutions. So The goal here, right, is to provide the technology for research that gives everybody access to diligence. And the way we've set this up is that you type in a ticker and you get an answer. And as I was saying before, right, we've got technology, and we've had technology for many years around transactions, right? So the quantity of trading has gone way up. I would say the quality of trading has gone way down. And when I say quality, I'm saying, it's not just about enabling transactions anymore. It's about enabling intelligent transactions. And we see this across all of our partners in the self-directed space. It's not just enough to provide cheap and inexpensive trades. It's now about how do we help our clients make money longer? How do we make our clients preserve their capital better? And that's a big job these days. And this is the kind of technology that has been in existence, and it's been encouraging people to trade more, but not trade as intelligently. And as a result, we've seen kind of a compounding effect, right? Holding periods are way lower, right? Holding periods in the mid 50s and 60s were 7 and 8 years. Now we're down to months, right? There's a lot of activity, a lot of intelligence. Well, guess what? Wall Street makes money. Every trade, they're making money one way or another. So make intelligent investments, right? And interactive brokers, I think, has always been in support of helping clients get past a lot of sort of the traps that get set by traditional Wall Street research and brokerage. So with this increase in trading, we've seen different types of markets. And I love this chart. This is a chart we used to use. And one of the things I like to point out is in this 15-year period, right, from the late 80s to the mid 90s, effectively that was such a huge growth period. It put value investors out of business. It put investors out of business. It was all about trading, right? Because if you tried to adhere to value investing principles, there's no way you can invest in stocks at this point in time because they were so expensive. If you didn't adhere to value investing principles, right, then maybe you could make enough money, or your returns would be better. I see some notes here about audio. I'll do what I can to fix my headset. Otherwise, I'm not sure what else I can do. I apologize for that trouble. But what I'm saying here is that if you adhere to value investing at this point in time, oftentimes you could be put out of business because your returns would not keep up with the range, right? And despite the fact that we had a flat market for about 10 years here, really, I've not seen value investing principles come back, not at least in the way that I was taught them when I first got to Wall Street. And value principles means, the investing principles means doing things with diligence, right? Being a dedicated type of investor or having a longer holding period. And this is another great data point around how the investing marketplace has changed. A survey of institutional investors by a professor at the Wharton School of Business, University of Pennsylvania, done in 2004. This came out of the Journal of Applied Corporate Finance. And so what he did is he interviewed a bunch of institutional investors. And what he found is that they self-described themselves in effectively 3 categories. Number one, 61% admitted to being closet indexers, right? For those of you that don't know, a closet indexer is someone who, to put simply, invests in 499 out of the S&P 500. And so they limit their downside, right? They don't want to have really bad returns and lose clients, but their upside is really not that good. And at the end of the day, they probably shouldn't be getting paid active management fees for effectively being a closet indexer. 31% transients. These were traders. These were short holding period folks. These were people that were in and out of stocks, not investing based on fundamentals. And then only 8%, and this is in 2004, right? We've seen the market since 2004 do a serious header back up, right? But only 8% described themselves as dedicated or long-term, really low turnover and large stakes, more of a value investing mentality. So we've lived through an age, the last 20 years or so, where raising money, and this is from the money management perspective, and as a former hedge fund manager, this is the case, right? I was good at managing money. We had good returns. I wasn't good at raising money. Raising money mattered more than managing money, because if you couldn't raise $100 million, it's really hard to stay in business. Now, I'm not saying that everybody is a terrible person and they're lazy or whatever for not being value investors. It's become increasingly difficult work. Who has time to read a 200-page annual report, 150-page or 250-page quarterly report? And that's what, 3 Qs and 1 K every year for every company, 1,000 pages. And if you're just going to look at 1 year, if you're going to ever model what you want to go back at least 5 or 10 years to really get an understanding of the profitability of the business, who has time for that work? The fact of the matter is nobody does, right? And the filings and the problem is only getting worse, right? I know because I worked for 5 years. I was on the investor advisory committee. I saw and oversaw more accounting rule changes coming down the pike in the next couple of years than have happened in the prior 20. And almost all of these require additional disclosures or footnotes that analysts need to understand, investors need to read in order to really understand the economics of the business. And I know because I've been doing this work for 20 years, right? And so footnotes are really where analysts make their money. And it's not anything you can get. It's not data you can get from traditional research, not Wall Street research, not any of these other research providers. New Constructs is the only research firm that I know of that systematically and with scale provides comprehensive information from the footnotes. And again, accounting rules are changing, and so it's more and more important to read these footnotes and make sure that the models aren't changing in a crazy way. For example, one of the rules I helped write when I was working with FASB was the rule that's bringing operating lease or off-balance sheet debt onto the balance sheet. Now, debt to total capital ratios are going to be all of a sudden a whole lot different. Any ratio with debt, coverage ratios, all these ratios will be very different once this rule goes into place, because all the debt that was previously able to be kept off balance sheet is all of a sudden going to be on balance sheet. So the changes in the debt capital for people is going to look, for companies, is going to look crazy different, unless you've got a source like ours that's going to be able to have made those changes historically already, so that our models will be apples to apples post that change. And that's the same is true with every change where that's possible. New Constructs is going to have done that work and done that diligence. So what's changing now? Why does fundamental research matter? Because, by the way, I agree with most people when they say fundamentals don't matter. Harvard Business School did a case study on New Constructs around how we can disrupt fundamental research by making it widely available at a very low cost with the same level of rigor as the professionals, which basically means why not use it? If we make it that cheap and easy to get, why wouldn't you take advantage of additional information? That's enough, in my opinion. A big part of change comes from the Department of Labor and the SEC, right? Talking about fiduciary rules. Whether it's a law or not doesn't matter. How many firms are going to advertise themselves as firms that are not willing to fulfill a fiduciary duty of service, right? So it's a matter of raised awareness. Investors need to ask. And quite frankly, I prefer it not be a law. I don't think we need to regulate that firms provide a certain level of service. I think clients or investors need to be smart enough to know to ask for that service. That's what we need at the end of the day, right? This has always been a buyer beware type market. We can't regulate the people to take care of themselves. But the way we can help them take care of themselves is helping them understand what the duty of care means with respect to the fiduciary rule, right? And so that means that if you're going to fulfill fiduciary duties, right, you have to understand there's the duty of care and the duty of loyalty. Duty of loyalty means don't overcharge people. Duty of care means we give people research that is high quality when we make investment recommendations, which means investors deserve better than the status quo, right? Technical research is great for timing. To give you any sense of what the fundamentals are, and we all know at some point in time the fundamentals do matter. I'm not saying that you should make 100% of your investment decision-making process focus on fundamentals, but it shouldn't be zero either, right? The other thing, sell-side research, Wall Street research, is it conflicted? You never know for sure, because the same disclaimers are in the back of every single report. And if everyone has ever read a disclaimer, give me a hands up or make a note in the question box, because I'd like to know how many people actually even ever read a Wall Street report disclaimer, because it will change the way you see the world if you see what's put in there. Effectively, they cover themselves with the rule of disclosure, the law of disclosure, which means as long as we disclose that we might be doing something bad or negative or contrary to what the report says, we are free of guilt. That's the way the SEC works. The other thing that's changing is that people recognize, more and more leaders recognize the inevitability of technology and automation changing the business. FinTech is all of a sudden means something. I've been going to FinTech conferences for 5 or 10 years. Now, I stopped going, I should say, after going several years ago because it was a waste of my time. People didn't even understand the problem we were solving. They were thinking about online lending or crowdsourcing and things like that. These aren't really ways to use technology. They're ways to use the internet to facilitate transactions, but that's not technology that helps investing, right? But today we're hearing leaders, some of the biggest leaders in the world, like Larry Fink at BlackRock, right, talking about in the New York Times how machines are rising over managers to pick stocks. He's using technology to augment humans. That's exactly what we're doing, right? Another firm, Autonomous Next, right, forecasts that over $1 trillion of cost savings will be taken out of middle and back office in the financial services industry. And a lot of that is related to research and research automation. They're simply processes that humans can do better than humans in this space. And when it comes to machine learning and AI, here's a big warning. Most of it is hocus pocus. When you hear about people talking about cleaning data, I urge you to ask them, how do you clean data? You take your hose pipe off and you wash the mud off? No, you can't clean it. There's no such thing as cleaning data. There's only validating it back to the source, which is where new constructs is really different. All of our data can be easily validated back to the source. That's what we specialize in. And we can prove the transparency of our models, the accuracy of our data, because you can always validate it back to the source. None of our competitors can do the same thing. They take data feeds from a variety of firms, CompuStat, S&P, Capital, IQ, Thomson, and that data is very different. It's very dirty. And that's been proven. You can go to our website and you can see that we wrote a white paper with Ernst & Young that proves the material superiority of our data. And so that's important to understand the difference between real AI and fake AI. So what's the idea? We provide technology that works for you. We help you improve the quality of your trades, right, and increase your wealth. Research that provides real diligence, so you're making more informed decisions. I would say appropriately informed decisions, right? And by law, when it comes to getting a fiduciary level service, I want you to know what to ask for and what to expect for those of you who are using advisors, right? And so we'll go to the law. A fiduciary must act with care, skill, prudence, and diligence, right? What does diligence mean? What does care, skill? What does this mean? Well, I think it means, and we've petitioned the SEC and the DOL to be more clear about this, but I think it means simply the research must be inarguably in the best interest of clients, which means it must not be at risk of conflict or based on diversification or entirely dependent on fundamentals. What it should be is comprehensive, right? All relevant publicly available information should be taken into account. It should be unconflicted. It should be transparent. You should be able to see what kind of work is done. It should be relevant, right? There should be some tangible, quantifiable correlation to fundamentals. We're not the only people that feel this way. Some leaders, including Interactive Brokers, Michael Kitces, MarketWatch, et cetera, these folks believe in the same thing as well. But for this to matter, you got to think about, well, what kind of trader are you? This goes back to my earlier point. Are you a speculator or are you an investor? Because there's a big difference. If you want to be a speculator, right, you focus on buying or selling based on what you believe about the near-term direction of price, right? Or if you're trying to forecast the psychology of the market, new constructs can't be that helpful to you. If you want to be an investor, and there's no reason you can't be both, right? There's no reason you can't add a little fundamental research to your technical research, right? But if you want to be an investor, that means your decision to buy and sell is based on the underlying economics of the stock you own. Investing is the activity of forecasting the yield on assets over the life of the asset. These are very different activities in technical research. So in order to deal with these huge amounts of filings, right, 1,000 pages a year for every company, we started building machine learning technology back in 2003. And this machine learning technology was driven by experts, right? It was experts using machines to go through filings. And I can go into more detail on this later. But the takeaway is we've done this for over 120,000 filings. We have the best training data set in the world for teaching AI and everything, but especially analyzing filings and building models. That's why Harvard Business School has done case studies on it. That is why Ernst & Young has written white papers on the superiority of our work, and they use it when they compete against McKinsey for consulting engagements. And this work makes a difference. This is from a couple of op-eds we've done with MarketWatch and wealthmanagement.com, looking at the difference between GAAP accounting earnings and economic earnings over time. You can see accounting earnings are more volatile, but most recently what we're seeing here in fiscal years 2006 and 2016 and 17 is that accounting earnings have been misleading. They're going up at an accelerating pace, while economic earnings are going down at an accelerating pace. This is part of why we've not seen the market move higher despite a lot of earnings beats. I love the quote that the editor for MarketWatch put on our first op-ed. Look at the financial footnotes and 10K filings, and the gains then disappear. Diligence matters, not just on the overall market, but on individual companies. Here's an example of a report we wrote back in early 2011, predicting that Eastman Kodak was going to go bankrupt about 9 months before they actually ever went bankrupt. And we knew this because we saw that they were monkeying with their pension plan, specifically the expected return on plan assets, was higher for Eastman Kodak than I think it had ever been, and for any other company that had disclosed that number, publicly traded company that had disclosed that number in fiscal year 2010. And it was so high that it actually allowed them to boost revenues by over 2% and earnings by many factors more than that, despite the fact that that pension plan was underfunded by $2.6 billion, or 3 times the market cap of the company. At the same time, the valuation of the stock implied a 10% compounded annual growth rate in net operating profit after tax for over a decade. So you've got really high expectations for future cash flow growth. Wow. The pension plan is being exploited to show earnings growth where there isn't any, right? Bad earnings quality, expensive valuation, that gets a very unattractive rating in our system, and the stock was down 90% within a short amount of time. As I mentioned before, don't just take our word for it. Ernst & Young did a white paper, which we're happy to share with anybody after this, and you get this straight from our website, that has an appendix that proves the material superiority of our data for 4 mega cap companies, Dow, Chemical, Caterpillar, and Comcast. And in the appendix, you can see how our data compares to big firms like Capital IQ and Bloomberg. So we show apples to apples exactly how our data is better. In addition, as I mentioned before, Harvard Business School did a case study on our robo analyst technology and how it expects we will disrupt fundamental analysis. When it comes to our clients, it's a wide variety of firms, right? We've got directors and officers liability insurance folks. We've got big partnerships with great firms like Interactive Brokers. We're all over the board with Scottrade, TD Ameritrade as well. Institutional clients at Wells Fargo. The majority of our revenue comes from hedge funds and institutional money managers. We partnered with Ernst & Young for consulting on a variety of platforms and a variety of access points, right? So for Interactive Brokers, you got 2 forms of access. Institutional access gives you access to unlimited amounts of research and tracking tools on our website. And this is particularly helpful for all advisors and IRAs as well as institutional investors. Retail access is a little bit less. The retail subscription on Interactive Brokers is mainly just access to our PDF reports Cynthia was showing. Then, of course, we've got custom engagements directly with executives in the C-suite at some of the largest companies in the world, helping them understand their own performance and manage that. Our system is very much built on an agnostic framework. We're sort of like open source for analyzing filings. We collect all the data. We model it in a separate way. So we have a lot of our institutional clients that have us perform custom calculations. And we don't care how you want to calculate it. We're just going to give you a better data set for that calculation. We're not here to sell methodology. We're methodologically agnostic. And you want to look at how New Constructs compares to other firms. We're the only firm that's going to give you consistent due diligence in the footnotes in the MD&A. We're certainly the only firm that can prove that we do that work. And I'll get to very quickly how our website works and how these tools work for you. But you can see how we stack up. There are a few other firms that claim to do this cash flow focus. Most of them won't even tell you how they do it. Almost none of them have models that will show you how they do it. You know, for example, Morningstar talks about return on invested capital and competitive advantage period in moats, but you can't find anywhere on their website how that work is done. You can't even find a formula for return on invested capital. We know, we've tried. So how do you access something like this? Well, on the institutional side, you get access to a website that will give you the ability to track an unlimited amount of tickers around, whether it's an ETF or a stock or a mutual fund. And the beautiful thing here is that you've got a seamless rating system for stocks, ETFs, and mutual funds, right? Green is good and red is bad. If you want more detail, we're happy to show you that. Here's how we break it down. We look at quality of earnings and we look at valuation, right? And this is where we saw for a firm like Eastman Kodak, you're going to get reds across the board here because they got misleading earnings, they got low return on invested capital, right? And they've got high expectations for future cash flows. Apple, on the other hand, is a little bit of a mixed bag, right? They've got really high, super high return on capital, but it's in decline. It's almost half of what it was just a couple of years ago. But overall, the stock is still cheap, right? Because I think the market's expecting that their profits will probably continue to decline, or at best stay the same, because they're in a competitive industry. But expectations for future cash flows are relatively low. That's what you see in these green side, on the green side of the rating system here, right? You look at, this is free cash flow yield, or free cash flow divided by enterprise value. Price to economic book value, that's the price of the stock relative to the no growth value of the business. Economic book value is calculated by looking at the net operating profit after tax divided by the cost of capital plus cash minus debt and several other adjustments to get to the value of the business, assuming no growth in cash flows. So when the price to economic book value ratio is 1.0, market cap equals the economic book value, which means the current stock price is implying that the profits will never grow from current levels. The value equals the no growth value of the business. And then the growth depreciation period is a reverse DCF model that is a very sophisticated model that most people never have time to build on their own. Well, we built a system, over the last 15 years to do this kind of work with scale. So you get the benefit of a model that doesn't attempt to pick the future, right? Or to predict the future. I always joke with all my new analysts, would you rather be a fortune teller or a critic of a fortune teller? Of course you want to be a critic. That's what our model does for Mr. Market, who has to be a fortune teller every day. He has to give us a price for every stock, ETF, and mutual fund. So what our models do is reverse engineer what kind of future cash flows the company has to achieve to justify Mr. Market's price. So you want to buy stocks that have low expectations for future cash flows and avoid stocks with high expectations for future cash flows. Our models and ratings apply to both ETFs, mutual funds, and sectors and industries. And you can see how the model here for the electronic equipment and parts industry works. You can see we got quality of earnings and valuation, the same metrics you see for individual companies, and then we show against benchmarks like the industry ETF, the S&P 500, and the Russell 2. You can see how the stats for any individual company, any sector, compare to major benchmarks. And of course, we've got screening tools as well. I'll pause for a minute here for some questions before I load up our website and start showing you how this works live. All right, I'm not seeing any new questions. So, to our website. Again, multiple models for access, Gold, Platinum, Pro. The only main difference is here that you're going to get access to more tickers each quarter. So, for $50 a month, you get 25 tickers. For $99 a month, you get 50 tickers per quarter. And for $249, you get 100 tickers per quarter. On Interactive Brokers, if you sign up for our institutional service, you get unlimited amounts of research. And the way it works is you have one or multiple portfolios, right? And in these portfolios, you can have stocks, ETFs, and mutual funds, as I showed before. You click on the plus sign, and you'll get breakdowns on how we arrive at our overall risk-reward rating for an ETF or for an individual stock. For that matter, we can look at an entire industry and get a rating. And we can do the same thing for mutual funds, right? So again, a seamless rating system. The unlimited use service through Interactive Brokers is $499 a month. Just to answer a question that just popped up here. So you get access to all this information, again, driven by, I think, the highest quality models in the business, right? You also get access to research, and so we're going to do a long idea every week, We get some really interesting ideas that we have been identifying. For example, was a value stock, Clorox, that we found that has higher returns on capital and better cash flows than a much more popular, I'm sorry, not Clorox, Colgate Palmolive, which is a much better business and a much better stock than Procter and Gamble, but it's not owned by value funds because the traditional accounting metrics for Procter and Gamble look better than they do for Colgate Palmolive, even though Colgate Palmolive has better actually value characteristics because the economics of that business are better because we've fixed the accounting to show that. Danger zone ideas every week. Had some very popular danger zone ideas. One recently was GoDaddy, which is super effective. Been a great short idea. We got a focus list where you can see all of the stocks we like the most, long and short, most attractive stocks. Every quarter, we look at the best and worst mutual funds for each sector, the best and worst ETFs and mutual funds for each style, model portfolio for executive compensation aligned with ROIC, safest dividend yields model portfolio, and dividend growth stocks. Those will be accessible as well on the My Portfolio page if you wanted to see where the most attractive stocks were for May. Here's that list, right? Or if you wanted to see the small cap most dangerous stocks, again, that list. And these could be all added to a portfolio if you wanted to track them. You could say, you could put this into a new portfolio, stocks to avoid, right? And that will be added to a new portfolio for you to track and get email alerts on anytime there's a change, right? There's the executive compensation aligned with ROIC. These are companies that get good ratings and have strong ties to return on invested capital as part of their executive compensation plan. Anyway, you get the idea. Here's our dividend growth stocks portfolio, focus list long, etc. Now, if we want to, does anyone want to give me a ticker to go through? Anyone want to throw in here in the Q&A section a ticker that you're interested in me going through so we can live? AT&T. All right, here we go. So here's my model. Here's what we think about AT&T. Here's to answer another question. Here's how our ratings have looked for AT&T, right? We were dangerous here for a while before it dropped, and we went to neutral. It came back up, and then and so we've our calls on AT&T probably haven't been ideal. We've shown quality of earnings has been bad for this business for a long time. And you can get more detail about the adjustments we make here. If you want a quick and dirty income statement adjustments, balance sheet adjustments, right? All this is highly transparent. Adjustments for the DCF model, right? We want you to know how much work we're doing for you, right? And for that matter, this service is not available through Interactive Brokers, but I want you to see our models, because what our models show you is a level of transparency and auditability that you're not going to get from any firm in the marketplace. I don't care if you are a $200 billion hedge fund and you've got every Wall Street firm in the world as a service provider to you. No one's going to give you models that allow you to look at multiple discounted cash flow modeling scenarios, or going to show you where the source data comes from. Right? Here are the filings from which we've collected the data. Right? Here's the balance sheet. Prove it to you. All those adjustments we make for AT&T, well, they come from a 10K. Income statement adjustments. Let's see, what do we have here? Here's some amortization of prior service costs. Well, this is a cost that they've put into operating earnings that's unrelated to the operations of the business. We pull this out of the pension table. Merger and integration costs. We're filing from a table that reconciles operating lost income before taxes reported in the consolidated statements of income. You won't see this in the income statement. You only see it in this footnote. Of course, there's some notes here for the Tax Cuts and Jobs Act. Same is true for balance sheet adjustments. Deferred compensation liability, you don't see that anywhere until page 82, right? It's buried in other non-current liabilities. Deferred compensation is a way for companies to manipulate earnings. They can set up compensation plans, defer it, put those assets on the balance sheet, and run gains and losses through the investments they're making with the deferred compensation cash, right, to massage earnings. Not cool. We pull that out. There's also something I suggested that FASB make an adjustment for because of the disclosures around deferred compensation are highly irregular. And we have some companies where deferred compensation liabilities and assets represent as much as 50 to 75% of total assets. FASB, unfortunately, has too many other things that they've been working on. All the valuation adjustments, we'll show you those as well, where they come from, right? And so the idea here is that we're going to give you proof of the diligence we do. No one else does that. Same is true with all of our historical data, right? All the data that goes into our models and all the calculations are here for you to see, right? The models go back to 1998 when filings were first made available in electronic form. We have all of our data going back as far as you want. This is what powers our reports and our ratings that you access through Interactive Brokers. We do reconciliations between net income and economic earnings, so you can see all the adjustments we're making to convert net income to NOPAT, all the adjustments we're making to account for the cost of capital in a business. And our models allow our institutional clients as well to make changes. I'm not here to sell you religion about how you should make adjustments. I'm just here to gather all the data so you're eyes wide open about what's really going on with the company. And so we'll show you all the adjustments we make to convert GAAP net income into net operating profit after tax. All the adjustments we're making to convert the total assets unadjusted to invested capital. Green dots are things that can be changed, right? We don't have a green dot next to everything because clients don't actually use all the green dots. They just go to the plug override. And they can change the NOPAT calculation to be anything they want. Same is true when it comes to the discounted cash flow modeling analysis, right? For institutional clients, you can look at an infinite number of scenarios around the future cash flows of a stock and make your own decision about whether a stock is cheap based on the market's expectations. So for example, expectations for future cash flows at AT&T look really low. In the default scenario, the stock needs 0 years of profit growth to justify the current stock price, right? That's why we see here the price to economic book value for AT&T is 1.0, which means the current stock is trading at a value that equals the value of existing cash flows. It's pretty cheap, right, as we've seen with the performance here. It's gone down a lot, but it could be cheap for a reason. So let's say if you're looking at our model, which is forecasting effectively consensus expectations for growth, profit margins, tax rates, working capital, and fixed asset assumptions, right? All this is something you can change and model. But to keep it simple, let's just go through a worst case scenario. Look back over time and see where margins have been the worst for AT&T. How far down have they gone? Looks like around 16 is the worst we've seen. That's what we're already modeling. So let's go for a worst case scenario. We'll call this pessimistic. Let's see what happens if margins drop to 10%. And the beauty of this system is that you can, in a matter of seconds, right, evaluate the impact of valuation of the stock based on your belief about a different future, right? And this is super powerful capability that provides ultimate transparency into why one person's opinion is different from another. And this is why you should demand from your existing research providers details behind their models, because at the end of the day, your target price is all about these assumptions. And if you don't know what these assumptions are, how can you trust the target price, right? So our models are not just updated every quarter or even more often for whenever markets change, but if there's a corporate event or anything like that, we're constantly updating the models to ensure what we're providing is the most relevant information for our clients, right? And we'll suspend our ratings if we feel like the financials are too old, if we haven't gotten a filing for somebody in a while. We'll suspend our ratings if there's been a acquisition, like with AT&T, right? Because we know that the economics of the business are going to change because how large that acquisition is. So we can't really assume that historical profitability of the businesses is representative of the future as it once was. And until we get the new Ks and Qs with that information, our models are sort of at a disadvantage. So we'll suspend the rating. We'll still show you what it is based on what we know, but we'll say basically this rating is suspended because we can't be as confident in the representativeness of existing financials for the future cash flows of the business. So with a lower margin, we see that it takes 24 years of profit growth to justify the $32 stock price. So what does 24 years mean? Well, 24 years is what you call the competitive advantage period, or the market, how much of a width, how wide the moat of the business is, right? This is how we're so different from a Morningstar or anybody else. They talk about the moat in this kind of conceptual way. We're telling you exactly how wide the moat is based on the market's expectations. right? If you assume they can contain margins, if they can keep margins at current levels, there is no moat. The market is giving the company zero credit for a moat. So if you believe it has any kind of a moat, well, then it's a buy. If you believe margins are going to come down a bunch, as low as 10% because of the competitive nature of the business, well, then maybe the moat around the business is not 24 years wide. Maybe it's expensive because the market's giving it credit for too wide of a moat. Right? We do not retroactively change our models or our calls. So what you see for a rating is what it was then and what it is today. So we don't change that stuff. If you want to see how the discounted cash flow model works, we'll show you exactly how it works. We'll show you all the numbers and calculations that go into how we calculate values per share, right? Here's the revenue number, the revenue growth assumption, the pre-tax profit, the profit margin. There's that 10% number I put in there, right? We can look at different scenarios if we want to as well. The tax rate, the profit margin after tax, the after-tax profit, the working capital and fixed asset needs that get added together to change in invested capital and calculate free cash flow. We find the present value of that. We accumulate that over time. Then there's a terminal value. By the way, it's a no growth terminal value. If the stock price produced by your model is too low, well, we don't think you should just jack up the terminal value with some sort of perpetual growth rate assumption, however people want to do it. Maybe you should build a model that goes out farther into the future. Why assume that every company's growth horizon is only 5 or 10 years? We're not predicting what the value is going to be. We're just modeling out far enough to capture market expectations, right? Here are all the adjustments we're making in our models to get to the implied values per share over time. And you'll see in year 24, the pessimistic model, we get to a price that's still closest to, but still less than the current stock price. And then we just do some math, look at what kind of revenue CAGR was achieved. That was the 2.4 we saw on the prior page. The average economic earnings margin or return on capital versus cost of capital spread, that's the number that's pulled up for year 24. That's when the model generates a value closest to, but still less than the current stock price. So you have a transparent view of the expectations baked into stock prices. We think that's the way valuation ought to be done. Not as the only thing you look at, but again, it shouldn't be 0% of what you do either. This is insight that we think every investor deserves to have. We're happy to democratize access to this kind of information for everybody. So that's how our models work. And that's what's going to be behind every one of our ratings for stocks, ETFs, and mutual funds. You can see we've got sector ratings, so you can see how all the sectors stack up. If you wanted to do a deeper dive, here's what things look like for industrials. If you want to break farther into industrials, you can break farther down into a smaller subcategory. And very quickly, you get a sense of, buy the best stocks or the worst stocks with a click. Here's what we do like, here's what we like, here's what we don't like. Same is true for ETFs and mutual funds. We'll even show you the overall economic earnings versus accounting earnings for the sectors at the sector level. You can see a huge disconnect between reported earnings and economic earnings for the freight and logistics sector. How's return on capital compared to cost of capital? What does the free cash flow yield look like? About price to economic book value? How about the aggregate of enterprise value compared to free cash flow? Or the aggregate market value compared to the aggregate economic book value? We can give you this view from both a top-down and a bottoms-up number. Again, all this work done, the highest quality data in the business. This is the way models should always have been built. It's the kind of work that I started out doing by hand on Wall Street and decided to build technology around. And we've been building this technology for 15 years. With that, I'll stop, and I'm going to turn over for some questions for the next 4 or 5 minutes here before I turn it back over to Cynthia. So performance tracking, yes, you can see that here under model portfolios, past performance tracking. We just updated our model portfolio performance through the first quarter of 2018. We'll show you the model portfolio performance for all our different model portfolios. Here's the first one is exec comp aligned with ROIC. You can see we outperformed for a while, underperformed. We're back around to outperforming since we've started the portfolio. And the one people pay the most attention to because they've been around the longest are the most attractive and most dangerous stocks because we've been publishing those reports since 2005. And I'll show you the charts real fast. It's done incredibly well for large and small cap. Not as well for large cap, even better for small cap. We look at most attractive stocks alone. Look at large and small cap together, the large cap and the small cap. And then on the dangerous side, shorting has not been a very successful activity. Look, I know as a former, I got my face ripped off plenty of times on stocks that I shorted just a little too early. And they announced that they had hired Bank of America to help them review strategic alternatives, and they shot up 30–40%. I got stopped out, and then 6 months later, the company goes bankrupt. So, shorting is a difficult activity. We systematically short in the most dangerous stocks portfolio, and we've still, we've peaked out a little bit of outperformance here, which is better than nothing. Any other questions? Yes. To our system. The retail product on Interactive Brokers gives you access to our reports. So if we're going to show reports, basically the reports are also available on our site. I missed those. But if you're looking at any particular company and you want to download a report, here's the report. It's the same thing you get on the website with a little more detail. You're going to get the rating, and then you're going to historicals on what the rating components have shown over time. So you're going to see how economic earnings have compared to accounting earnings, how return on invested capital is compared to the cost of capital, price versus economic book value, a summary of the reverse DCF model. We'll also give you a summary of one of the things that's favorite for from our hedge fund clients. And that's the number of adjustments and the size of the adjustments that we're making for individual companies. So we'll versus the average for all and the million, right? 9 income adjustments, where we increased, and 15 expense adjustments where we decreased, right? 13% of companies make more adjustments to earnings than Interactive Brokers. On the retail side, you get access to these reports. And then on the institutional side, you'll get access to this capability, which gives you access to the reports as well, but you'll also be able to put together portfolios, as many portfolios as you want. Here's our stocks to avoid portfolio, and you'll get alerts and ratings for everything in your portfolio. Portfolio alerts, we can do that daily, weekly. You can turn on what you want to get, right? So I need to turn some of these guys off because I've been Leo's here for a while. Weekly email alerts, daily alerts. We can send you alerts whenever we add things to coverage. We'll send you alerts, or you can have multiple addresses. So you can have your primary email, and you can have an assistant or partner also get emails with these alerts. Do we provide? Not yet. We were going to be expanding our coverage to the rest of the world in the next 6 to 18 months. That's a big focus for us. Right now, we've been focused on sort of where the most meat on the bone is, and that's in the United States. And we're building out and improving our technology. The auto parsing technology is a big focus for us, and we need to get that technology up to top speed before we start wearing our analysts out covering companies in a manual way when we can cover them more automatically. There's unlimited research, which we normally charge $1,000 a month for. Access to models is significantly more expensive, and we really weren't sure that the Interactive Brokers community was really ready for the models. Quite frankly, we didn't have the kind of training and support tools and communication that we needed with Interactive Brokers to support selling a product like that. So we really only sell the unlimited research portion of our institutional research service at Interactive Brokers at this time. I hope everyone can hear me. I just got a question and someone said they couldn't hear me. Sorry. Hopefully the replay will have better. Screening tools, yes, tons of screening tools. You can screen, for example, if you wanted all the very attractive stocks in consumer cyclicals, diversified retail with a return on capital greater than 10%. In 2 seconds you can get the list. You could add that to your watch list or whatever you would want to call it, right? And have something else to track as well. You can search on stocks and ETFs and mutual funds. Again, this is available through Interactive Brokers on the institutional side. And so you can screen on the same thing for ETFs and mutual funds. I only want very attractive. I only want large cap. I need to make sure they have at least a billion and 100 million in assets. Otherwise, who knows if they're going to be sticking around that long. There's the list. I could add all of these to my portfolio, right? I could say watch list funds, right? And track those as well. And we can, of course, screen according to more things. The other institutional point of access is really downloading data, and that's something that you can. That's the other aspect of our institutional service that is not available on Interactive Brokers. What is best forward-looking inputs in products? I'm not sure I understand that question. Yes, we track almost all U.S. ETFs. So leveraged or not, they're still going to be in our screening tool. We're sort of careful to warn people about leveraged ETFs. I think that's a little bit dangerous. But we do offer the ability, for example, to download on individual stocks data points that you can put into Excel. That's an institutional level service that's not yet available on Interactive Brokers. Education section of our site provides white papers on all the adjustments that we make, as well as explanations on all of our metrics, economic earnings, return on invested capital. Again, we're completely transparent in everything we'd like to do here, and we want you to know exactly how we do it, because it's not about the fact that we've got some fancy black box. We just have better data, and what most people are trying to do with a shovel, we're doing with a bulldozer in terms of getting the data needed to create good models. We're about to run out of time, so I'm going to turn it back over to Cynthia to close us out.
Well, David, thank you very much. A lot of very good information here today. And this is going to conclude our session. But I do want to remind you that we have been recording, and each of you will get a direct link to today's recorded playback soon after the session ends. So be on the lookout. Watch your inbox for the follow-up messages later on today. By the way, this will also be posted on the Interactive Brokers website. You can find not only today's presentation, but previous items from David as well by simply going to the education menu. You'll find a webinars link where you can access directly from locate by presenter name. So look up David Trainer's name and you'll find the other webinars he's been doing with us as well. So with that, we are going to conclude today's session. I want to thank all of you for joining us here this afternoon. Have a great rest of your day, everyone. Thank you.